I'll start taking some questions from you. Okay, so do feel free to start putting these questions in the chat. Okay, so first one from Manan. So Manan, 20-year-old in university, but also working full-time, trying to get a mortgage for a buy-to-let. Houses that you're looking at have been around 150k, and you're looking at buying with a deposit of around 25% under a limited company. What type of interest rates would I be looking at? Well, Manan, it's very much a case of working out what the rent looks like and what the stress test on the rent looks like. So once we know what the lender is willing to offer based on the stress test, then we can determine kind of what rates you can have. We are finding at the moment that actually 75% loan to value, or in other words, a 25% deposit mortgages, are a little bit harder to get. Reason being is that the rental stress tests are quite harsh because the interest rates are quite high at the moment. So Manan, you've just popped in there, rent's about $750 per month. Now, I'm not going to be doing any live calculations today. However, if you use the QR code that's on your screen now, book into my appointment, and we can definitely have a chat about what's possible, because $750 a month against $150 property value seems like you're kind of in the right ballpark. Depending on where in the world you're living, you're probably looking at rates around starting at about sort of 6.5%. They're a little bit more expensive if you are living abroad, but certainly do scan that QR code, get booked into the diary, and what we'll do is we'll go through your query in a bit more depth. Unfortunately, I'm not going to have time on this call today to go through sort of a fact find with every person. It's just trying to get an idea of answering a few of your queries that you might have. So if I move on to the next one, we've got Matt. So are you allowed to buy buy-to-let properties if you've bought your own home via a shared ownership scheme? Matt, I can't see why not. They're not going to be linked. So you wouldn't be able to convert your existing property into a buy-to-let, usually without paying off the shared ownership. But if you were looking to buy a property alongside as a buy-to-let, can't see any real sort of glaring issues with that. We would need to check that the lender is comfortable with it, because obviously, effectively, you've got more outgoings in the background as you've got a mortgage plus the shared ownership rent. So providing the numbers stack up, I can't see a reason as to why that might be an issue for you. Again, if you want to scan a QR code, you can get booked into my diary. We can go through it in a bit more detail. And then what we can do is we can start approaching lenders with that query for you and try and get an application in. So Russell has asked, what typical mortgage loans and values are available right now for overseas investors? So overseas is a little bit of a trickier market. Good news for us is that we do work with lenders that sort of specialize in overseas. And at the moment, we are looking at around sort of 70%. Most lenders will do. There are the odd one or two lenders that might go up to 75%, obviously providing the rental stacks up and everything like that. Key thing as well is whereabouts in the world you're based. So different countries have different lenders, are open to lending in different countries, obviously based on, the banking systems in those countries, what the risk profile is and things like that. So all of that plays in. But generally speaking, you're going to be looking somewhere between sort of 70 and 75% loan to value for the top end. And obviously, when it comes to loan to value, the more deposit you can put down, the better rate you're likely to achieve. Okay. So if we move on to Larry. So Larry has said that he's put a reservation fee for a buy-to-let, which is due in completion September 2024, and he wants to do residential in the coming months. Would I have any challenges obtaining 2 mortgages in 12 months? The time frame for obtaining 2 mortgages is not really a big issue. I would always say to start looking at your mortgage options about 6 months in advance of completion, to make sure that you can kind of explore all your options and get an offer in place that will be ready for when you want to complete. The very, very latest I'd leave it is about 3 months before. Reason being is there are some legal processes that have to go on to obviously make sure that, you know, the mortgage can complete on time. So I would say there's no real issue in going for 2 mortgages within 12 months. The only thing that you should factor in as well on that one is how many credit checks you want done. So obviously, as part of a mortgage application, you will need to do a credit check. Now, with those credit checks, they do usually put a little dent in your credit file for a short period of time. Now, it's not a big deal if you're doing 1 or 2, but if you start doing loads and loads of them, it can really knock the credit file down a bit. So just be careful from that standpoint. And obviously, if you're using us, we'll make sure you're aware of any time there's a credit check going on. And if you're using any other sort of broker or anything like that, do make sure that they tell you every time there's a credit check so that you know to expect that on your credit file. Yeah, hopefully that answers your question. Okay, so moving on then to Matt. So if I buy my first property via SPV company, am I still considered a first-time buyer when I buy my first home? Can the LISA be used towards first-time retirement? So with that one, I would say you need to have a chat with your solicitor about how they're putting all that through. I unfortunately can't answer that question because it comes into almost legal advice. So I'm kind of bound that I can't answer that question, unfortunately. But I would either say speak to either an accountant or a solicitor who are trained to give advice in that area, and they can tell you exactly what they can do, because effectively they're the ones that are going to be sending off the TR1 forms, which is going to dictate the stamp duty, and they're also going to be sending off the application to the government to claim the lifetime ISA funds as well. Okay, so moving on to Eric. So during my earlier webinar, oh, Eric, you've come to both, much appreciated. You mentioned the loan application process is very efficient, less onerous with a quick in-principle approval. Can you elaborate on what kind of documentation or information is typically needed for the loan application for, say, a 40% LTV case? Yeah, absolutely. So we can generally get you a decision in principle really, really quickly. To be honest, for an initial decision in principle, we don't ask really for any documents up front. We obviously ask you to be honest and accurate when you complete your application form. We would send those details on to the lender. They would come back to us with agreement in principle. Now, when they come back to us with that decision in principle, what they usually do is they usually have a document list that comes with that, and they'll tell us exactly what we need. Now, with that document list, you usually have to provide things like payslips, bank statements, your proof of where your deposit funds are coming from. And sometimes we'll need to see details of tenancy agreements if you've got other buy-to-lets in the background. But generally speaking, the most common are bank statements, payslips, and source of funds. So yeah, hopefully that answers your question, Eric. Okay, so if I move on then to Robert. So Robert has said that he's bought a property outright last year, renovated it, and currently anticipates that the property has increased in value by 50 to 75%. Well done, that's a strong renovation, that really, really good. What level of remortgage would you recommend to provide funds for further investments, repay the initial investment or more? So unfortunately, I can't provide you with any advice. Okay, so we do all of our mortgages on a non-advised execution only basis. I can tell you what would potentially be achievable though. So depending on what you're planning to rent the property out for, we could apply a stress test to that, and then it would generate a maximum lend. Once we've got the maximum lend, we can sort of split that lend up into different loan to value brackets. So we could look at what the borrowing would look like at, say, 50%, 60%, 70% loan to value, based on obviously the new purchased or the new property value. Once we've got a good idea of what the rates look like at each of those loan to value brackets, you can make a sort of informed decision on how much you wanted to borrow. And obviously one of the options you've got is if you're looking for further investments, you could borrow enough for, say, a deposit on the next one and then mortgage the next one. And if you keep the loan to values low on both of them, it means that you wouldn't have to have such high rates, because you wouldn't have, say, a small deposit coming from one property and then a small deposit on your next purchase, which will mean a higher rate. So effectively, instead of doing, say, one with a large deposit, one with a small deposit to get a low loan to value, you could have a equally low loan to value on both if you draw from both properties. So interesting proposition that you're looking to achieve there. You've also followed up with the second one. We're currently starting short-term holiday lets. Do we need to wait say a year or to show the performance? No, not necessarily, Robert. If you've got the property rented through a sort of a holiday let agent, they will be able to provide a anticipated high, medium and low. What I mean by that is, what they'll do is they'll split the calendar up into weekly rental estimates. And what they'll do is a short-term letting agent will tell you that what the property is going to achieve in sort of the peak months. So if it's down by the coast or something, they'll tell you exactly what it's going to achieve in, say, the summertime. If it's somewhere in a city centre, they'll tell you what the most popular months are for letting. So for example, I know if you were to buy a property in, say, Bath, a lot of the time around the Bath Christmas markets, it's really, really busy, so your rent is really, really strong. So no, you don't need to wait a year to show the performance. What we would look for is a letter from a holiday letting agent, and then what that would do is provide us with a high, medium and low season rental estimate per week. We would average that out, and a lender would do a stress test based on that average. Most lenders, from what I'm aware, will look at the average of the high, medium, low divided by, or times by roughly about 36 weeks of the year to account for time where the property is not rented. We do find that with short-term holiday lets, actually you can achieve a lot more in terms of borrowing, because the profit from them is much, much greater. Hopefully that answers your question, Robert. Eric has said he had a question earlier, but he forgot to mention that for joint owners, one is working, one is retired. What is required for the retiree to provide support for the application? Good question, Eric. Usually it's just a pension statement and then a corresponding bank statement. So if you had a pension statement saying that you were earning, I don't know, £1,000 per month, we would need the bank statement showing that £1,000 goes in per month to that bank statement with the matching sort of name for the pension fund. Yeah, so that's usually absolutely fine. The one thing that I would mention there is that if you have got clients that are, if I've got clients that are in retirement, they may well be capped regarding age. So some lenders do have age criteria. Some lenders won't lend, say, above the age of 75. Some are not bothered. Some will go up to 99, 100 years of age. We do have to just factor that in to make sure that you can have the correct term that you want to have without falling foul of their age requirements. Okay. So we've had somebody anonymously put in one here. So is it possible to get lending for a buy-to-let if currently employed, or if the income solely from another buy-to-let, which nets less than £10,000, but has significant savings for the deposit? Answer is yeah, it is possible. So yeah, you can absolutely look for lenders that have sort of no minimum income requirement. We do work with one or two lenders that have that facility. What they will look at, generally speaking, is that you don't necessarily have to have a lot of income coming in, but they will check what your outgoings look like. So for example, if you've got sort of a sub 10K income, but you had a lot of credit card debt, or you had a lot of loans and finance and things like that, then they may not look favorably on it. But generally speaking, if the rent stacks up okay, and in terms of your financial position personally looks in a good state, they would probably be happy to lend. Okay, so I've had one there from Umut. So what are the current interest rates? What causes them to fluctuate? And how do they vary for different types of mortgages? Really good question. Current interest rates at the moment, if we're looking specifically at sort of limited company buy-to-let mortgages, you're looking at sort of in the region of sort of 6 to 7%, I'd say is a good rate at the moment for limited company buy-to-let. The reason that we'll start off actually with, well, in fact, yeah. So what causes them to fluctuate? The main thing that causes them to fluctuate is going to be the Bank of England base rate, really. So the Bank of England base rate to some extent determines how much lenders will have to effectively borrow that money for. So if a lender is trying to build a lot of funding so that they can lend out mortgages, what they'll do is they'll borrow from other financial institutions at a certain rate. Now, if this rate is set at, say, 5%, 5.5%, whatever it may be at the time, they also need to make a bit of profit on that. And so when they lend that money out to the consumer, they'll obviously put a little bit on top of it to make sure they're making a profit. And then when the Bank of England base rate moves, they can borrow money more cheaply or more expensively, and that will impact how mortgages fluctuate. That's the main kind of reason. Now, if you drill down a little bit further than that, the Bank of England base rate can move for a number of different reasons. If we look at recent times, the Bank of England base rate is moving quite a lot due to the inflation rate. And the inflation rate is very, very high, and it's not coming down at the speed that the government wants it to, which means the Bank of England base rate keeps on going up. And then to answer the second part of your question, how do they vary for different types of mortgages? In terms of how they fluctuate, it doesn't really differ for different types of mortgage, whether it's residential or buy-to-let, for example. They're all going to fluctuate because of the same thing. What you will notice, though, is that some different lengths of deals can differ quite a bit. So, for example, it always typically used to be that a 2-year fixed was cheaper than a 5-year fixed, back when borrowing was really, really cheap for the lender. Now, as borrowing has got more expensive for the lender, we're actually seeing that the 2-year fixeds are higher than the 5-year fixeds. Now, the reason being is purely that the swap rates that lenders use to assess what might happen in the market going forward and the cost of borrowing over time is cheaper the longer the lenders borrow the money. And that means that basically for the longer products, you're actually paying a little bit cheaper because the bank effectively thinks that the rate might go down over time. And the shorter term ones are costing the bank more money to get the funding for, so they're a bit higher at the moment. So hopefully that answers your question, Amit. That was a really good one, thank you. Okay, we'll move on to Jonathan. So Jonathan's got a few buy-to-lets, 75% loan to value, fixed until 2026, 2027. Hopefully you got a nice, good rate there, Jonathan, just before everything went a bit mad. I was thinking of sharing my good fortune with tenants by not increasing their rent in line with inflation. I've been told this might be a good intention, but I might fail to get a full remortgage, even if there's still 5 years left on the term. Could you please give us some clarity on this issue? Interesting one. If you've got a good rate on there, obviously, your rent is obviously doing the job that your tenants are paying at the moment. It's paying the mortgage, everything like that. And you might be thinking, yeah, I don't want to increase the rent because, I've got good tenants and things like that. Don't want to lose them, which is absolutely fair enough. It's not an issue. It's not a right now issue. Could be an issue come 2026, 27. If the rates are still high, what you need to really be looking at is if you were to look at the rent that you're getting now and put that into a stress test against the high rates that we're currently seeing, does the mortgage still fit, basically? And if the mortgage doesn't fit, then you may need to increase the rate, the rent later on. Some might argue that it might be easier to up the rent in increments so that it's not such a shock to the tenants. that's up to you to decide. But I would say if you're concerned, if your thought is that the rates will still remain high in sort of, what is that, 3-4 years time, then I would say put the current rent in a stress test to see where it sits, and that will give you a good indication of whether or not the rent will need to go up. What I'm going to do is I'm just going to move on. I've got a few people here who have raised their hand as well. Could I ask all the people who have raised their hand just to pop the questions into the Q&A section? Is that all right? Just because I don't think it's going to allow you to actually speak live, that's all. And I will look out for the ones, when I see you raise your hand, I will look out for the ones in the chat, okay? Okay, so an anonymous attendee has asked, what are the rates for mortgages that do not require a minimum income? Are they usually higher? Very much depends on the lender, to be honest, and the time. So what we will find is that lenders do change their rates from time to time. A lender can go from being the top lender one day, literally, to being halfway down the pack in terms of mortgages later in the week. What you usually find at the moment, where there's a lot of demand for mortgages and the rates are particularly high, if a lender sort of fills their boots of applications because they're offering a very, very good rate, within a few days of that, if they need to stop the applications coming in, either because they've run out of funding to some extent, or their funding's getting lower, or because their service levels have increased so much because they're taking on so many applications, they might end up hiking the rates. This happens all the time, to be honest. So whether or not they're usually higher specifically for that scenario very much depends on the situation that we're in. It's not something that's usually a correlated as such. It's just a point within the lender criteria. Okay, so Betty has asked, do you do mortgages of property rented to housing associations? Housing associations are really tricky for lenders, usually because there's sort of laws and stipulations within the rental agreements, which can make it really, really tricky for them should they need to repossess the property if you weren't keeping up with the payments. Housing associations, I'd say, is very, very much case by case situation. I would say if you've got a property that you're looking to purchase or remortgage that is housing association, what you're better off doing is following that QR code, get booked in. And what I can do is I can approach the lenders for you and see which ones are comfortable with the situation, because it is an ever-changing market and housing association is particularly tough at the moment. The other thing we find with housing association is, generally speaking, because the rent is guaranteed for a set period of time, the rents don't tend to be that strong, which means the stress tests are quite hard to pass with the lenders. So I hope that answers your question, Betty. So Jonathan has asked, following up from that earlier question, he's asked, the fact that I have 5 years to run on my term from 26-27, there might be a risk on the loan to value not being rolled based on the stress test at the time. Yeah, absolutely, Jonathan. So the stress test is basically assessing how much money you can borrow against that property based on the rent. So say, for example, you had rent of £1,000, and you did a stress test a couple of years ago, and for that £1,000, the lender was happy to lend you, say, I don't know, £200,000, which at the time was 75% loan to value. Fine. If you'd come, 5 years later, and you've still got £1,000 rent coming in, but the stress test now means that you can borrow only, say, 150,000 because the stress test is harsher, you need to find the gap between the 150 and the 200. Okay. Now, that's not to say it's going to be unmortgageable, because your existing lender will be able to provide you with some new terms going forward. It might just limit your options if you're remortgaging away. That's all. And of course, that 150 versus 200K complete estimate, you would need to run the numbers based on your actual scenario to see the difference. Mazin has asked, any expectations on the base rate increase or decrease in the next 12 months? Good question, Mazin. I wish I had a crystal ball to see. You know, the inflation rate is still very, very high. I would say the next Bank of England meeting is a very good tell, because what will happen is the inflation rates will come out usually a few days or a week before, and they will give us a good tell of whether or not the Bank of England are going to increase the rate. I think from memory, the last figures on the inflation rates are about 8.7, something around that figure. If they've not dropped fairly dramatically, I think it would be safe to assume that the base rate might go up, because they want to get the inflation figure down ideally to 2%. And to do that, they need to obviously increase the Bank of England base rate to do that. So I think it very much hinges on it. It could go up a couple more times before it comes down. What I would say though is, if you are looking at buy-to-lets and you're looking to invest, it's not really trying to time the market that's improper. That's the thing to do. It's about looking at your long-term goals on it. If you go back and you look at, say, the last 25, 30 years of property has generally always gone up over time. Rents have always gone up over time as well. And so the thing to think is, if this is a long-term proposition, actually, because we're in a bit of a tough market at the moment, you might be able to knock a little bit off the purchase price, which will sort of outweigh that extra interest that you pay on your mortgage for a few years. So it's not something that I would necessarily be put off by. But yeah, if only I knew, Mazin, if only I had a crystal ball there. Now we're coming to the end now, so I'm just going to try and rattle off a couple more questions. Okay. So Matt has asked, will the rates or loan to value required on a holiday let mortgage be significantly impacted if you don't own your own home? No, it shouldn't do, Matt. It shouldn't be. The rates and LTV shouldn't be impacted, because they're largely based on, those two things are based on the stress test on the rent. What may factor in is if the lender doesn't do what they call first-time buyer, first-time landlords, or non-owner occupier mortgages. So if you don't own your own property, that's more of a criteria point with the lender as opposed to a rate or LTV point. So you'd have to identify a lender that's sort of comfortable with first-time buyer, first-time landlord, or non-owner occupier mortgages. Other thing that might factor in there as well is if you've got any landlord experience. That does factor in. If it's a purchase that you're sort of looking to do, or a remortgage you're looking to do, Matt, do scan the QR code, get booked in, because we've got lenders at the moment that are comfortable with you not owning your own home. There's no problem there at all. Okay, so final question that I'm going to answer, and then we'll call it a day for today. I will be running these mortgage clinics once a month. Okay, and they will be for 30 minutes every time. So I'll jump on and just answer as many questions as I possibly can. Okay, so is it easier to get a mortgage for an HMO or housing association? Definitely HMO. HMO is definitely easier. Do make sure though that you have got the right licensing in place. Okay. Yeah, that's absolutely not a problem. What I will do is I will put all of these questions into and have a look through them later on, and obviously try and get some answers put together for you guys. Do scan the QR code though and get booked in if I didn't manage to answer your question. I'll be more than happy to have you booked in to answer all your queries, and obviously to push things forward for you if you're doing a remortgage or a purchase. But yeah, thank you ever so much for your time. That's all I've got time for today, and I'll see you soon. Thank you. Bye-bye.